is the way forward looking like for the market? To discuss that, we have Mr. Surjitt Singh, the PMS head of PGM India Mutual Fund, joining us on this show. Hi Surjitt, good to be speaking with you. Let's begin by discussing the market mood itself. We had seen a bit of a recovery after that volatility or the bout of volatility that we had seen a couple of weeks ago. But do you think this is purely on account of that election-related, nervousness? And once this is done, we'll be back on the track of making fresh highs for the market?
Yeah, thanks for having me on your show. So there are two aspects to it, right? One, if you look at the earnings season, which is underway, broadly the numbers are in line with expectations. So that is one which is also driving the markets. The second, as you rightly said, rather than elections, it's the stability of government and the continuity in terms of reforms, which market will look at very closely. So we are like 15 days away from the results. I think let's wait and watch there. But if there is continuity and stability, I think market will take it positively in our view.
Okay, so you're maintaining the fact that, of course, continuity is something is what markets like. But what's the sectoral view right now? And I'm especially intrigued about asking you about banking and IT, because there's one end of the market which believes that, these sectors have been underperforming on account of the FII selling. It's expected to reverse now. It's perhaps bottomed, and it could be a good time to bottom fish some of the names in IT and banking majors. Would you concur with the view there?
So if you look at our PMS strategies, which we have at Pigeon, right, we have been underweight financials and we have been underweight IT. Now, just to give you some inputs on banking per se, if you look at last 3 years, let's say private sector bank, the earnings CAGR for these banks was in excess of 30%. And if you look at next 2 years, that is FY24 to FY26, on an earnings CAGR basis, and I'm quoting the Bloomberg consensus here, it's around 16 to 17%. So the growth is slowing down. That's point number one. Second, if you look at the credit growth for the industry, for the banking industry, it has been more than 15% vis-a-vis deposit, which is less than 12-13%. So the deposit growth is lagging the credit growth. Ideally, in this scenario, what happens is the net interest margins for banking per se as an industry might come under pressure. And according to one of the reports by CRISIL, they expect 10 to 20 bips impact on net interest margins for the banking industry as a whole. So given the earnings profile of last 3 years and the strong trajectory in earnings, compared to that, earnings might be slightly on a slower side. And given that deposit mobilization could be a challenge, you might see net interest margins for banking industry as a whole also coming under pressure. So we are playing, BFSI through differentiated themes, but purely from a banking angle, we continue to be underweight at PGM PMS. Whereas on IT, if you look at the commentary of all the heavyweights in IT, currently there is no visibility in terms of revenue trajectory for the companies. And if you read through the con call transcripts of these companies, they are still alluding to the fact that the discretionary spend, specifically in US, is not picking up. So there is a lot of uncertainty to as when the revival will happen on the revenue front, and that continues to keep us on sideline because despite the correction in these stocks, valuations are in our view not that reasonable given the context of earning profile for next couple of years for these companies.
So expecting the earnings to degrade further for the banking majors and not high conviction about the recovery of the IT sector. But then where are you deploying fresh money? Because the momentum is clearly with industrials, with the PSU names, but they aren't cheap by any yardstick.
Absolutely. So we have been, cutting down on our exposure to industrials. So as you rightly alluded to, we continue to be overweight industrials. But let's say 6 months back and today, we have reduced our exposure to industrials. That's point number one. The other sectors where we are quite positive is auto, healthcare, and building materials. Because if you look at real estate as a cycle, I mean, last 2-3 years have been quite robust for grade A developers. And with the next leg of growth, when people actually get possession of their houses, you will see the incremental impact coming on building materials. So we continue to remain, positive on building materials. Within healthcare, we are positive on hospitals because we believe that is a classic case of operating leverage. And a lot of hospital companies are actually now into capex mode. So whenever there are new capex comes in, whenever the new capacity comes in, we believe hospitals will see a lot of operating leverage at play, and hence the earnings profile of healthcare companies and specifically hospitals could be quite robust going forward.
Okay, so expecting an uptick when it comes to the entire hospital space, but why not play directly, let's say, through real estate itself, Surjit? Is valuation a bit of a concern there?
Yes, absolutely. In our view, if you look at the run up in the stocks, all the real estate, if you look at reality index, it was one of the best performing index in FY24, right? So in our view, lot of positives are getting captured in the current valuation of direct real estate plays. Better way in our view is to play, the building material space, which is derivatives of real estate doing well.
The view on metals as a pack, because that's turning around a bit. Is this a space that you would like to perhaps look at incrementally, or the cycle is just too difficult to call, so stay away?
There are certain aspects which are hinting at slight recovery in China. So China being the elephant in the room, if there is recovery in China, it has repercussions for metal per se, right? That's point number one. And over a period of time, people are thinking on the lines of, interest rates, which might peak out in this financial year. If that is true, then again, it is again a sentimental positive for metals. And as you rightly alluded to earlier on your show, that metal companies are giving a lot of inputs in terms of incremental things improving in terms of prices. So last 2 3 days, whatever numbers have come from the metal pack, the management are alluding to the fact that prices are looking up. And we talk to other companies also. They are also of the view that incrementally material cost and specifically metal cost starting FY25 has seen some uptick. So if that sustains, then yes, metals could be one of the decent performance in this year. If you look at our core equity portfolio in last 3 to 4 months, we have added couple of metal names into our portfolio.
Okay, so at least incrementally turning positive on the metal space. But I wanted to come back to the point of industrials that you were talking about. It's become a very large and varied sector, right? Right from defense to, of course, your ABB Siemens of the world to the transformers, rectifiers, and then you have, other names coming in terms of electronic manufacturing, etc. Within that, where are you trimming position, and which is the pocket within that entire industrial space that you still think comfortable holding on to your positions?
So within industrials, as you rightly said, it's a very vast sector. But if I have to give you certain inputs of how we are playing that, so we are more comfortable with defense names. We are more comfortable with bearing space. Barring that, overall as a sector, the valuations have gone through the roof. And if we get some correction over next, let's say 2 to 3 months, we might look at them. But as of now, we stay put on defense as well as the bearing sector per se within the industrial pack.
That explains it. And within healthcare as well, again, are you looking at pharma companies in terms of the CDMO manufacturers, or you're just looking at pure play hospitals or diagnostic companies?
So it's a mix of both. It depends on which strategy you're talking about. So currently in PGM PMS, we have 3 strategies. So a couple of strategies have more exposure to hospitals. A couple of strategies have exposure to direct pharma place. So we are playing CDMO space. We are very positive on the CDMO space from a longer term point of view. But from a next 1 to 2 year point of view, we believe operating leverage could play in hospital stocks, and hence we continue to remain overweight on this space per se.
Surjit, on that note, I'll let you go. Good chatting with you today. Thanks so much for making time and speaking with us. But on that,
if you like this video, then like, share and subscribe to ET Now.